Good evening once again, ladies and gentlemen. On behalf of Motilal Oswal Financial Services Group, it's my pleasure to welcome you to the 16th edition of the annual Wealth Creation Study by Mr. Raamdeo Agrawal. The Motilal Oswal Wealth Creation Study is an annual event that presents a unique looking back and looking forward perspective to the Indian capital markets. Based on the research and data for the last 5 years, the first part of the study will determine the biggest, fastest, and most consistent wealth creators. The second part will look forward to provide an insight into some of the biggest trends that will impact the capital markets going forward. This study will then be followed by a very insightful panel discussion comprised of elite members from the capital markets. To get the proceedings rolling, I would like to invite Mr. Motilal Oswal, Chairman and Managing Director of Motilal Oswal Financial Services Group, to address us. Sir.
Good evening, friends. It's really a pleasure for me to welcome you all for our 16th annual Wealth Creation Study program. Let me start with a very small anecdote or story. It's about Albert Einstein, who was a professor. We all know Albert Einstein, who was a professor in Princeton University. Is that audible? I am audible? Or all right? This side? Yeah. I think when I was sitting other side, there was some echo, so I thought that there may be some problem. So, Albert Einstein was a professor. One day he took one of the exam for the students, and once the exam was over, one of his assistant came to him and said, "Sir, can I talk to you for a minute? I think there was some mistake you committed in giving the paper to the students." He said, "What? That the paper which you given this year is the same as the paper what you gave last year." So Einstein said that, "Dear friend, yes, there is no mistake. The paper is same as what I gave last year, but all the answers have changed." And same thing is true in our market. We know, I think, the question is that how to make money, how to create wealth, but the answers are completely different based on the market sentiments, based on, I think, the corporate performance, and a lot of kind of macroeconomic and other variables. So this our annual study is also about finding those kind of answers. It's an annual, as I said, annual study, and every year Raamdeo and the team put in a lot of efforts, at least in last 3 to 4 months, in finding out those kind of answers, that how to make money, how to create wealth. And every time they come out with very different answers. So the question is same, but they have to find the real, relevant, and different answers. As Peter Drucker has said that the true indicator of a good performance or the future performance is the past performance. So while we going through a lot of data analysis, we try to really understand the past to really invent the future. And in that process, Raamdeo and his team go through a lot of data, a lot of analysis, a lot of kind of, I think, balance sheets. Left side of the balance sheets, which is basically liabilities. Right side of the balance sheets, which is the assets. And many times they find that there is nothing left on the right side, and there is nothing right. Many times they find that there is nothing right on the left side. And in that process, I think there will huge number of companies. We have seen Satyams or I think MF Global and all. So very difficult to say whether the assets or liabilities kind of, I think, right or wrong, or what is left behind and all that kind of stuff. So it's a very interesting and analytical and very time-consuming process. But I think once you hear him, you'll find a lot of ideas, a lot of insights, and very practical tips about how to make money out of that. I think we have got a very interesting, I think one of the best in the capital market, which is the panel today, Ramesh Damani, Madhu Kela, and Rakesh is also on the way. So I'm sure we'll find a lot of interesting ideas and very good debate. And I can assure you that it's going to be, I think, great, wealth-creating kind of, I think, theme for all of you. And with this, once again, welcome you all.
Thank you, Mr. Oswal. So guys, ladies and gentlemen, this is showtime now. Let me tell you that for the last 2.5, 3 months, internally at the group, there is a fairly high degree of secrecy and anticipation about the study that will be unveiled today. It gets harder and harder to get closer and closer to Mr. Agrawal as we get closer to this event. So with that backdrop, let me now welcome Mr. Agrawal, who needs no introduction. He's one of the foremost equity research minds in the country, one of the leading value investors, and we would definitely learn something new today. And I'd like to invite Mr. Agrawal to unveil the study to us over the next few minutes. Sir.
Good evening, friends. The moment I came, Ramesh said, there's so many people, market can't be at the bottom, you know. So I'm very thankful for seeing you all here. It's really a pleasure. It's a celebration time for me. And after 2 months of rigorous so-called data crunching and going through. Yeah. So after 2 months, now the day has come when I can interact with you all and present whatever little findings we have. This time we have chosen a very interesting subject, blue chip investing. I mean, it's very commonsensical. Everybody knows what is blue chip, and it's very exciting and very dreamy to have blue chips in your portfolio, but I think we all know that those blue chips are not in our portfolios. So, and why it is not there, how we can get to blue chip investing, and how we can load more and more blue chips in our portfolio so that we can keep making money without effortlessly out of these blue chips. So let's see how the data comes out and how I'm able to communicate to you the ideas we have generated. So 2-minute salute to the great dividend paying companies. Investing in blue chips is all about getting more and more dividends. It's a fountainhead of dividends, you know, all the companies which are blue chips. So look at Asian Paints. It's in last 20 years, they've given 55 times dividend to the purchase price then, and market cap is up 75 times. Nestle, dividends up 51 times in 20 years, market cap up 82 times. So these are the kind of numbers which comes out when you look at the dividend, you know, when you look at dividend history. I mean, any company, I never realized, having invested in few of the blue chips like Hero Honda and all, I never realized that dividends are that important in investing, and what makes a difference between a blue chip and not so blue chip is only the dividends. And dividend connection is very, very strong. So one of the books I was reading, and then I came across what is the definition of blue chips in USA, and they run very long data series, 50 years, 100 years. That luxury we don't have. So we have a data series of about 20 years, and on that basis we have done this particular study. 4 companies, Asian Paints, HUL, Nestle, and Hero Motocorp, if you add up, dividends are up in 20 years by 75 times, and market cap is up 70 times in last 20 years. And you see how dividends build up to the, you know, the final climax. And we think that this is the end of it, and after that what? In last 20 years, this much has happened. What is going to happen in next 20 years? So, and is it end of it? But you will be surprised, the blue chips live much longer than what we think. I mean, they typically live 100 years, 80 years. Most of the banks are 100 years old. And today you are one of the blue chips. Just to give an example, HDFC Bank is only 15 years old. You can decide how many more years this company, this bank has on its fold. So we tend to underestimate where exactly, what is the longevity of this blue chips. Reliance, today it is a 2 lakh crore balance sheet. What was it 10 years back? I mean, at 10 years back also it was the largest company. It was just about 12,000 crores balance sheet. Today it is 2 lakh crore balance sheet. So you know what happens in 10 years? 10 years is a very long period. I mean, we are worried about tomorrow and next quarter and next year, but once you look at investing in slightly longer framework, you realize that a lot of things have changed. So our salute to this fountains of dividend blue chips. Somebody said a cow for the milk, a hen for her eggs, and a stock by heck for its dividends. So always stock, you get, as an investor, you get only dividends. And I'm quite sure there are a lot of people here in this crowd who have enjoyed investing in blue chips and how their portfolios become rich by year after year, the dividend flow into their portfolios. So the present, this was just a kind of a preamble to what is going to come. So the today's presentation is in two parts. First is the wealth creation findings, what has happened in the last 5 years in the wealth creation field, and then a few slides about that. Then the current theme of blue chip investing, and then the conclusions. So let's go to the first wealth creation findings for the current year. Concept of wealth creation is process by which a company enhances the market value of the capital entrusted to it by the investors. Net wealth created is the concept of, in last 5 years, how much is the change, net change of the market capitalization in the marketplace. We take all the companies which have created net wealth of 100 crores, and this time the smallest wealth created is 3,700 crores. So top 100 companies which have created at least 3,700 crores have been included in the study, and we have given 3 categories. First is the largest wealth creators, fastest wealth creators, and the most consistent wealth creators. So let's look at the largest wealth creators. Largest wealth creator, again, 5th year in a row, is Reliance Industries with 1,71,000 crores added in last 5 years. 1,75,000 crores at the rate of 21% compounded. Now, in last 16 studies, this is the second time that Reliance has scored 5 times in a row. I mean, earlier than that, first time, HLL in 96 to 2001, it was all HLL for 5 years straight, I think with a gap of 1 year, 4 plus 1. So 5 years Hindustan Lever ruled the roost. After that, it was ONGC, and now it is Reliance. My sense is Reliance has done its wonderful job in last 5 years, and they will find it tough to compete in wealth creation with the things like TCS or HDFC Bank. They are growing very, very fast, and they're closing the ranks very, very quickly. My sense is that you might see a change of guard in next 12 months. This is a fastest wealth creating group. Is the, everybody loves to have very fast appreciating company, very fast in the sense that 100% or 80%, 90% per year, because your portfolio can change very dramatically. So, but you see, Savaria Agro is a company which has gone up by 50 times in last 5 years at 119% every year. I mean, like every year it is double, more than double. But I mean, we could have said that Savaria Agro is not a company we should be including in this in this study. But the statistical counts, they throw this company. We looked at the company; it's a real company. Maybe there is unexplainable reason why it is here. But then quantity of wealth created is 4,200 crores. And one of the, typically what used to happen earlier was that these kind of companies, they were never able to make it to this level because the kind of wealth they were creating was 500 crores, 200 crores, 300 crores here and there. But now it is 4,000 crores. The size of this kind of change in the price is also become very big. Speed thrills, but it also kills. Most of these companies, including even Infosys, Wipro, and Unitech, to mention in last 10 years, what happens is these companies, they grow very rapidly, and next 2 to 3 years, they correct by as much as 98, 99%. 30% minimum and 98% at maximum. So one has to be extremely careful. Of course, 1 or 2 of them in the portfolio can change the color of the portfolio or your this thing, but investors as an aggregate, today I can buy, if I had bought Unitech at 200 crores and sold at 80,000 crores, which looking back, it looks to be a dream. It could have changed my profile. But as an investing class, I'm selling it to a brother who is another investor. So if you look at the total investing class, it leaves a lot of disastrous result, and it doesn't help. So one has to be extremely careful while investing into high-speed wealth creating machines. They create transitory wealth. They don't create permanent wealth. So one has to be extremely careful. I think the most coveted position is for the most consistent wealth creating companies. And this time, 10 out of 10 studies. I mean, this is the category where in last 10 studies, the companies which are made up, those are the companies which come here. And happily, all 10 companies are made in all 10 studies. So this is first time. In fact, there are 12 or 13 companies which are made in all the 10 studies. So up to 21% growth have made up here. I was surprised to see the name. Kotak Mahindra Bank has been the fastest growing, most consistent wealth creating blue chip, I would say, in this category. Then Sun Pharma, Asian Paints, HDFC Bank. I mean, these have been the kind of usual suspects, but Kotak Mahindra Bank is one new star which is born in the blue chip arena. If you look at the Sensex, in last 5 years, it has grown by 12%. The 100 wealth creating companies, they have grown at about 18%. And Sensex CPS has grown at 14%, Wealthex CPS have grown at 18%. So all these companies, they typically outperform the Sensex in every aspect, whether it is fundamental or at the speed of wealth creation. This is very interesting. What has happened is that if you see the total wealth created is about 22 lakh crores in last 5 years, and the financials, the banks, NBFCs, and what you have in financials, they have become the largest wealth creating group. I mean, this is the emergence of the economy, the prosperity in the economy. I mean, I think at some point of time in US, the financials had gone to as high as 40% of the wealth created, or in fact, the market cap itself was about 40%. So here, now we have reached a maturity level where financials are contributing almost 24% of the wealth created. And my sense is now permanently, till last year it was oil and gas and things like that, but now financials have created the highest position, and my sense is it is going to stay here with emergence of new private sector banks growing very aggressively, and we have in pipeline private sector insurance companies now getting listed. So I think up to 25% of wealth will be actually created, and hence in your portfolio also, one should have a very good dominant position of high quality financials for wealth creation. Then you have metals and mining. I think we have a setback now, but so it will get lower rank. Things like auto, FMCG, I think they are going to see the rank higher in the years to come. We have seen that growth companies have been rewarded very, very handsomely. In fact, market has, despite its efficiency, market has not been able to price adequately the companies which are growing at rapid pace. See, India is a place where you can find this very rapid growth companies and widespread all over, and markets are not able to price this high quality, high growth companies adequately. So what happens is that if the company actually delivers 50%, you still make a lot of money. So high growth, I mean, typically markets are supposed to be efficient in knowing the pricing the high growth companies adequately, but we have seen after that Y2K debacle, markets are very, very cautious in pricing the high growth companies. As far as the valuation is concerned, you buy below 10p, you make sure and very fast money. Like below 10p companies, like there were 14 companies, it grew at 25%. If you buy between 20 to 30, then also you made about 22%. But clearly, if you buy single-digit P multiples, and this is the market when you can get single-digit P multiple stocks. So, I mean, yes, it feels very depressing to see the market every day, euro, this problem, that problem, but this is the time when you are going to get the stocks very cheap. I mean, maybe it can become a little cheaper, but this is the time when you'll get single-digit stocks in the market after a long time. Now, this is the last slide in this part of presentation is about the wealth destroyer companies. I mean, we have seen wealth creating companies. I think we have all suffered in the hands of a lot of these corporates. And the company which has destroyed, I mean, we have created about 22 lakh crores net wealth in the market in last 5 years. 3,25,000 crores have been total loss in last 5 years. And of that, 30,000 crores have been lost by Suzlon. 25,000 by Reliance Communications. Satyam Computer has lost us about 23,000 crores. So like this, the list goes on. But if you see the businesses, I mean, it has come from all the businesses. I mean, except for probably consumer, but basically all kinds of, you can see a lot of telecom companies. You can see technology, airways. So all these companies have lost money. So be very careful buying these low quality companies at high prices. We'll come back to that again. So now we have come to the main theme of this study, that is blue chip investing. So creating wealth from dividends. I would like to touch upon what is investing in speculation, because this is a very, very misunderstood, very simple concept, but very misunderstood. An investment operation is one which, upon thorough analysis, promises safety of principal. First thing is safety of the money which you are investing in, and an adequate return. Operations not meeting these requirements are speculative. Second is even more insightful. If one buys stocks and buys as an investor, you can buy as an speculator and buy as an investor. So when you buy as an investor, he holds for income. This is a basic fundamental difference between a speculator and investor. When investor buys the stock, he buys for income. And when you buy as an speculator, you only buy for change in the price. You can ask yourself why you buy the stocks, and you will know the answer whether you are a speculator or investor. So, what is important is when you invest, like when you invest in a farm, when you invest in, you invest in farm for getting the productivity out of it. When you invest in a company, you should be investing for getting productivity, earnings and dividend, more particularly dividend out of the stock. But I think dividend is so small in current environment that people have forgotten what is dividend. I think people are only busy in figuring out how much will be the price change in his 1 or 2 years or 3 years of holding. And most of the people, they want, by buying the stock, the moment he buys, the stock price should go up, and in 1 year time, it should basically double. So that's the basic expectation. So basically, most of the people who are coming to the stock market now is coming for change in the prices, which is very, very speculative in character. And even a lot of institutional investor, for whatever reason, has also become, maybe the money is short term, maybe funds are open-ended. They are also, their focus is also, bulk of them, their focus is change in the prices, not so much earnings out of the, they have tremendous research capabilities, but eventually the decision is made for change in the price rather than incomes from the investments. So what is blue chip investing? Blue chip investing is necessarily that you buy a portfolio of blue chips and stick to that. I mean, you have to supply tremendous discipline in terms of saying no to low quality ideas. And what are the blue chips? Highly priced stocks. I mean, blue chip is like a definition. It's about the quality stocks, and you can have your own definition, and everybody knows that what is a quality stock. The problem is that they are very unaffordable. They are high priced stocks. And the concept of blue chip comes from a poker game where the chips are blue for the highest price denomination. And somewhere in 1924 or 1925, Wall Street Journal writer, he said, all these stocks are very expensive stocks, let's call them blue chips. I mean, they are blue chips of the stock market. So that's how the concept of blue chips came. And then later on, the definitions were derived for blue chip concept. So why blue chip investing? I mean, okay, blue chips are there, red chips are there, not such high quality stocks are there, all kinds of stocks are there. So why blue chip investing? The main thing is the problem of poor quality. Benjamin Graham, in his Intelligent Investor, right at the end, just before he ends, he said the risk of paying too high a price for good quality stocks, while a real one, it's always a problem to pay high price for the Nestle or a Lever or things like that, is not the chief hazard for confronting the average buyer of securities. That's not the real problem for the investors. Observation over many years has taught us that the chief losses to investors come from purchase of low quality securities at times of favorable business conditions. You think about them. Most of the problems in our portfolios are not because of HLL was bought at 300 in 2000 or Infosys is bought at 10,000 rupees in 2000. It is the problem is, like personally I have gone through, I actually bought Infosys at 900 rupees in 97 or 98, sold at 11,000 rupees, but guess what I did? With that money, I bought CompuCom at 400 rupees and sold at 20 rupees, and the price is even lower than that after that. So, the problem is not having Infosys at an inflated price. Even at Infosys, that's not the defensible thing to go and buy at 10,000 rupees. But even if you had bought at 10,000 rupees, still you could get your money back and some more change, maybe 15,000, 16,000 rupees equivalent you could have got. But the real problem is getting into portfolio in favorable times very low quality stocks, very low quality stocks. So that's the main one problem to get into the quality. And there are very few quality companies. Blue chips are 100, 80, 90, 100 companies in any market, not only in India. You go to US, you go to Japan, the quality companies are very few, counted. And so is in India. So your problem is very small if you stick to the 100 companies. But 2,900 companies, they are very large. You end up getting into wrong company at wrong point of time, and that becomes the main problem of every investor. I mean, institutional investor as well as more particularly the retail investor. And then advantage of high quality on top of it. Good quality companies with strong dividend histories offer as much, if not more investment growth potential than poor quality companies, and they do so with far less risk. We'll come back to, we'll give you the actual demonstration of how high quality companies not only has potential to make more money than even Sensex, forget about very low quality companies. And that too at a half the risk, which is tremendous for investing. Second is longevity, and power of compounding works in longevity. As I said, the average average median age of 48, 50 blue chips we have looked at is 57 years. The companies live much longer than, good companies, they live much longer than we think. I mean, Motilal Oswal Security is already 24 years old. We think we are a kid. Hero Honda is only 26 years old. I mean, we think that it has become world's biggest two-wheeler company. There is a lot to go. 25 years is nothing in a history.